Hey guys, what's happening? Hey, sorry about that. Man, was that weird? My First of all, my mic wasn't picking up, so you couldn't have heard me even if I'd gotten into the stream. And then secondly, when I just decided I'm just going to reboot the computer. It's been on all day. It's probably got all kinds of stuff going on in the background, so I shut it down and I went to reboot it, and it would not come back. I mean, I tried everything I knew, and then finally it just miraculously appeared. So I appreciate you guys hanging in there because I was really looking forward to tonight, and I did not want to get rid of it. So fortunately, I'm here, but I am a bit late. So welcome to the program. I'm glad you're here. I'm excited to be here with you as well. So tonight we got an interesting topic. We're going to talk about dollar cost averaging. And I might need some water. That's kind of stressed me out after not being able to get online with you guys. So looks like there's 11. Oh, no, there was a little delay there. There's 16 now online. And so it's great to have you guys here. So let's take a quick look to see who all's in the broadcast. We've got Pat. Pat, welcome to the broadcast. Let me know, too, if you're actually hearing me and seeing me okay. It says everything is going fine, but you just never know. We got Slammer 6789, and you got the notification. Fantastic. Normally, I start these on time, but, hey, tonight it's just what it is. So I'm going to learn how to pronounce this. It's Yamomanam Jazz. So let me know if that's even close, okay? But I appreciate you being here, man. And Billy is he's in the house. We also have Kamarai, also known as Chris, and I know I did that backwards, but hey, what the heck? Yeah, Billy says your channel should have 100,000 subscribers, and of course, while I was waiting for my PC to reboot, I just said, we only have, I'm not that one. We only have 99,000 to go, or 98,000 to go. So that's awesome, Billy. I appreciate that, brother. And Greg Pulaski is in the house giving me some encouragement on trying to get this thing set back up. We got El Dynamico from West Sacramento. He is, I'm not sure if he's really blind. I think he's just, not able to see the comments for some reason, but welcome to the program, El Dynamico. We got Ben from Quebec. That's awesome. And let's see, we got Kevin Rayberg in the house. Welcome, Kevin. Let's see. So El Dynamico said, you never realized how hard it was for me to decipher what you said. So let's see. Michael Swami, he's late, but hey, so was I, brother. Better late than never. You know what I'm saying? And OJ, welcome, OJ. So and then my buddy Russ Knopf. Hey, thanks, man. I'm glad you came by. Just popping in for a few minutes. That's fantastic, man. I really enjoyed the live stream you did with your wife. I think that was really, it was good of her to do that with you. And, I don't know that I could ever get my wife onto one of these live streams. So, those are maybe some lofty goals I would have. So let me ask you this. I'm going to go ahead and get into this topic on dollar cost averaging, but I also want to know, the market is kind of turning downward, which is not a huge surprise. I mean, it just went crazy at the end of the year. So, what things are on your mind? What are you looking to buy? And are you buying now, or are you kind of waiting a little bit? So, and then maybe this dollar cost averaging discussion will have something to do with that. So I'm going to, since I wasn't able to really prepare ahead of time, I prepared ahead of time, but I wasn't able to get online and get everything set up. So I'm going to go ahead and share this presentation. So pardon me as I do that. And then I'm going to, there it is. There it is. So I'm going to, let's see, I'm going to do this. Maybe that'll make it a little bigger. Maybe I will do something like that. So hopefully that's That's good. So the question for tonight is, and what we try to do here is we try to educate a little bit. There's a quite a variety of experiences that are watching this program. So some people are like really advanced, and some are just getting started. So I try to hit a little bit of the middle of the road. And so tonight we're going to talk about dollar cost averaging. So first of all, is it a good strategy is our question. So first of all, what is dollar cost averaging? So dollar cost averaging is the practice of investing a consistent dollar amount each period, regardless of the price per share. So I thought this picture was really good to have on here as a description. So just think of every red dot as a purchase, as a consistent purchase. So and then this wiggly line here is the price of the shares. I'm not really sure what I guess that's the average price. So that orange line would be the average price of all these purchases. But the red dots, every paycheck, entering into a transaction in the stock, regardless of whether it's low or whether it's high, or whether it's in the middle and it goes back low again and it goes back up. You're just consistently every time investing the same amount of money that is then buying shares. So that is dollar cost averaging. So let's get into some nuts and bolts here and start really popping the hood on dollar cost averaging. There's a lot of people that'll say, hey, I'm DCAing into this, or hey, are you going to DCA that? And so if they say that, this is what they're talking about. They're talking about dollar cost averaging. Let's move to the next one. These are some examples. So I've tried to describe it. Now I'm going to show it. So this is obviously a fake example. This is 6 months. So you can see here months 1 through 6. Then we have $100 that's getting invested every time, regardless of the share price. So you see there's $100 in month 1, 2, 3, 4, 5, 6. Then we have the share price of this fictitious stock. $10 in month 1. It was 8 in month 2, 9 in month 3. It jumped up to 13 in month 4, back down to 9 in month 5, and then hit around 12 in month 6. So you'll see that in month 1, we put our $100 in. The share price was $10. So we were able to purchase 10 shares. So that's all well and good. And then we get to month 2, we put our $100 back in. The share price now is only $8. So guess what? We get 12.5 shares. So we got 10 shares last month, but we got 12.5 with the same money this month. Now, the third month rolls around, it's $9. We got 11.111 shares. Then it jumps to 13. We only get 7.692 shares. So you kind of get the idea here is that you're putting a consistent dollar amount in, and you're buying the number of shares that $100 will buy. So at the end of the 6 months, we end up with 60.747 shares. And if we divide that by the $600, if we take the $600 divided by the number of shares that we purchased, we get an average price of $9.87.7. So by doing this in the dollar cost averaging in, we were able to buy more shares when the price was down, less shares when the price was high. And the theory is that you end up with a lower cost per share than you possibly could have otherwise. So that's one example. That's a fluctuating price. Let's look at number 2 example. We've got a steadily increasing price. So we're going to take the $100 contribution, same 6-month period, same contribution, but this time the share price doesn't jump around up and down. It just continually goes higher. And so you'll see that we're able to buy 10 shares the first month, just like in our first example, but then less than 10, about 9.4, 8.9, 8.7. So we end up with about 55 shares with an average price of $10.91, let's say. So in both of these cases, we're doing pretty well. Obviously with the fluctuating price, we come in a little bit better than we do on the steadily increasing price. But overall, DCA is pretty good way to get a consistent approach to investing. And we'll talk about what the benefits are and what the risks are to it here in just a second. Well, actually, right now. So, what are the benefits of dollar cost averaging? These are from my perspective. So, there's probably others out there. If you got some other benefits or risks, let me know. But the benefits as I see them are you have the potential for lower average cost per share. And that potential is that you're buying consistently. You're not trying to time the market. So sometimes you're going to buy high, sometimes you're going to buy low. And so you spread that risk of price over a longer period of time. Secondly, it reduces the emotional reactions to investing. So, as all of you know, sometimes investing can be emotional. So when we have stocks that go down in price, a lot of times as a human being, we see that going down and we're going, I got to stay away from that because it's going down. When in reality, that's probably the time we should be buying, right? And so when it's going up, we have this human reaction that says, everybody wants a piece of that. I want some of it too, right? So we have a tendency to be more comfortable when buying when prices are going up and less comfortable buying when they're going down. Dollar cost averaging takes that emotion out. You say, I'm going to invest a certain amount for this particular period, and I'm going to do that and then not even think about it. So that's benefit number 2. Benefit number 3 is it reduces your risk of investing a large amount of money in a single stock at the wrong time. So you could, if you're not dollar cost averaging in and you say, I'm just going to buy, boom, you buy, and it happens to be the peak, and then you're kind of stuck with a stock that is trading below what you bought it at. So, dollar cost averaging kind of helps balance that out. What are the downsides of dollar cost averaging? The way I see it is you're less likely to result in oversized returns. So why do I say that? I say that because you're less likely to get the lowest price for the stock. I'm not saying it's a bad thing. I'm just saying, that is a downside, is that you're not going to lock in at the low. You're going to, lock in with an average price over a period of time. It's just a mathematical thing, right? Number 2, it does not guarantee a profit. If the stock price continually drops, and in my examples, they actually went up, but if the stock price continually drops and you're dollar cost averaging in, you're still going to be losing money, right? So it doesn't really guarantee a profit. Number 3 is that the risk of paying too much for certain shares. So for instance, if you think of it in terms of value investing, there's a fair value for the stock. And so you run the risk of paying higher than fair value prices. I'm not saying that's a big deal. I'm just saying that is a downside of this process. And then fourthly, it removes the investor from valuing the investment. Now, what do I mean by that? There is a skill, there is an investment principle and skill that we can build by learning how to value stocks. And so dollar cost averaging kind of takes the value piece of the stock away because you really don't care. You're just buying on the same schedule. You're buying the same amount of money every time. You don't really care what the value of the stock is. So it kind of takes the investor away from getting better and learning more about how to value a business. So those are, at least from my perspective, the downsides. So what are some takeaways before I get to some of these questions here? So takeaways are dollar cost averaging is a valid investment approach. I used it, especially when I was younger. I would put money in the 401k plan every paycheck and it would just buy whatever shares it bought. So I think it is a valid investment approach. It does not guarantee that you're going to get the lowest price, but I'm not sure I could guarantee any process getting the lowest price. But I mean, it is a takeaway. Dollar cost averaging removes the investor from the valuation process. I see that as probably the most egregious thing, is that you really don't care what the value of the stock is. You're just buying a stock. And then fourthly, DCA can lower the emotion of buying shares because you're just saying, hey, I'm putting my $100 in and whatever it buys, it buys. And I think that's a positive thing. So, but the last thing here is something that I learned not too long ago, actually, maybe 5 or 6 years ago, is that DCAing a lump sum. So, one thing is, hey, every paycheck I'm paying so much out of my check and it's just DCAing into the market. And I think that's fine. If you have a lump sum of money and then you're saying, hey, I'm going to DCA this into the market, that's kind of where this plays a role. So a lump sum can lead to what I call delayed regret. And you say, what is delayed regret? So if the stock, if I'm DCAing in and I put my first purchase in, I've got this pool of money sitting there waiting to be invested over time. And then all of a sudden, so I've invested part of it and the stock price goes down. My first regret is I should have waited, right? So you'll be saying, oh, I should have waited. I put this money in and I should have waited. If it goes up, then you're regretting not putting the whole thing in. So, if you've got this lump sum of money, just recognize, and you're going to DCA it in, just recognize that you are going to feel regret one way or the other. It's going to happen. So if you decide to DCA in, just realize you're going to feel that regret and just move on with life. So those are kind of some takeaways. That's the last slide that I have. So I'll go ahead and get rid of this. Put me back on here. And I'm not sure where I was here. Let me back up here and see where. Okay, El Dynamico says he can hear me, but he can't see me. So that's fine, my friend. You just keep your ears tuned in, and we'll be in good shape. Hey, thanks, Suzuki, man. I appreciate that. I'm never late. I'm always early to stuff. So when I'm late to something, it really kind of stresses me out. So, but I'm back now. I'm feeling good. I got my water, and that's really all I got. I got my water. So, and I got you guys, and that's what I was really looking forward to tonight. We got Fast Eddie in the house. He is from Fort Worth. So welcome, Fast Eddie. Let's see. Yeah, so Pat says he buys monthly, whether the market is up or down. I think that's a fine approach. That's that's what I did for my career, and I don't do it as much now. But just maybe a little backstory. Why don't I do it much now? So when I retired back in 2021. I began investing some money that I would get every month. And so I was doing some dollar cost averaging in there. And then I bought this farm here in Alabama. And we also bought with that a house that we were remodeling. So this past year has been about investing in that house. So I really haven't invested much in my portfolio. It has grown. It's grown because the market did so well last year. But I haven't put a ton of money in there. So that's why I haven't, but I do plan to start putting money back in the portfolio. So I'm with you, Pat. Every month, you'll probably see me dropping a few dollars into the portfolio every month. So now not only do I get to invest my dividends, but I also get to invest some real capital in the market. So I'm looking forward to that, my friend. So Fast Eddie says he likes a hybrid method, half DCA, half lump sum. So, that works too. So, it'd be interesting to hear, Fast Eddie, if you've had success with that. And it's really going to depend on what the market did. And that's a real point of all of this, right? We don't know what the market's going to do. So we want to be investing. So whether we invest lump sum, whether we invest hybrid strategy, whether we invest DCA, whatever keeps us motivated and keeps us investing, that's what we should be doing. So just wanted to pass that along. We got Ricardo Risa in the house. Welcome, Ricardo. Oh, yeah. OJ, you got 62K waiting for a pullback. That's fantastic, man. So what would that be as a percentage of your portfolio? I mean, is that like you have like a huge portfolio, or is that, 50% of your portfolio? It'd be interesting if you don't mind sharing, what level that would put you at as far as percentage of cash. Yeah, yeah. Ex-dividend dad says he says, I love some DCA. We had a great discussion last night about DCA, so I'm right with you there, my friend. I know exactly what you're talking about. Yeah. So Russ says, "Wow, I don't feel so bad at 4K waiting." And those of you that watched my video over the weekend, you got to see the entire portfolio, every holding that I have in the portfolio, as well as the cash. And if my memory serves right, I think I'm sitting around 50K. So I don't have as much as OJ does, waiting for a pullback. But I do have some, so that's good. Let's see, Billy. Billy says, I like to start buying and continue buying when price drops. If it continues up, no loss. I'll wait on the sideline. My original buy is about 50% of what I want. That's a great approach, Billy. And, I've had to learn a little bit of that over time. I'm not quite to where I'll put 50% in yet, and I'm learning that I probably should. But I have got to the point where if I'm going to invest in a stock, then especially if it's a new stock, I'm not going to invest in it unless I'm comfortable putting at least 1% of the portfolio in there. So that's like, 13 to 15 grand, something like that. If I'm not comfortable putting that level of money into an investment, I'm not going to invest. So I'm going to hold that money and wait. So I think that's kind of where Billy is. And so I appreciate you sharing that, my friend. Okay, OJ's going to invest it by February, but he's in no rush, and I don't think he needs to be in a rush, at least with what I see in the market right now. Russ says he's same here. He was working on 100 Johnson & Johnson and thought we'd see closer to 140. Stalled out at 72 shares and have cash waiting. Good luck, my friend. Hope it goes down there for you, because if it does, I'm a buyer as well. 140 would be a great price for Johnson & Johnson. Yeah. Michael says he's a forced DCAer. He gets paid, he invests. That's exactly the way I did, Michael, when I was, in my career. When I got paid, that's when the money went into the market. And so that is forced DCAing, but it works, it works. But, once you get to the place where you've got this portfolio and you're trying to manage this portfolio, you're going to have lump sums of money. And so, DCAing may or may not be the best approach. But, that's the cool thing about our portfolios, is that each one of us gets to decide what we do. So that's fantastic. And so my goal with DCA was not to help you decide whether you do it or you don't do it. It was just to talk about what it is. What are some of the benefits? What are some of the downsides? And then you get to make your own decision, which is the way we want it, right? Sergio, welcome, my friend. Any thoughts on AJG? I was wondering if you had ever reviewed the stock. I am not familiar with AJG, so let me log into Simply Safe Dividends. Usually I'm logged into all of this stuff. AJG, Arthur Gallagher Company. I'm going to go ahead and pull this up for everybody to see. I've got to stop sharing that one and start sharing this one. All right, there we go. I'm going to take Sergio's comment off here, and we'll look at Arthur Gallagher. It's got an 85. It's a very safe rating. Pretty low dividend. It's a 0.98% yield. It's got a nice bit of growth here in 2023. Let me get my cursor to where it will actually move the screen. Okay, so it's about insurance and reinsurance. I think I have heard about this stock. I tend to invest in the larger insurers, but let's take a look. We got a payout ratio of 26. That's fantastic. Last 5 years, it's a 6% dividend growth. Look at that trend line. It does have a bit of a flatness to it around. Hey, that makes sense, right? It's 2009, 2010. It's back 2008, back during the great financial crisis, and then it just continues to rise. So They've got a dividend growth streak of 12 years, which would make sense back to 2010. And they've been paying a dividend for 30 years. So let's take a look at some of their graphs here. Hopefully you guys can see this. Man, their earnings payout ratio has been continually declining. I'm not sure why that is. And so first of all, that's fantastic, right? That it's got a low earnings payout ratio. But when the earnings payout ratio is increasing or decreasing that fast, it makes me wonder why they're not sharing, especially as an insurance company, why they're not sharing some of that with the shareholders. So, I mean, look at their cash flow payout ratio is 17%. That's pretty low. Earnings per share are really jumping up. Free cash flow per share is jumping. They've issued quite a bit of shares, but if they're able to convert that into money, that's okay. Sales are up. Return on invested capital is in the 12, 11% range. That's certainly not a problem. Net debt to capital is 36%. A little short on the interest coverage, but that might be a little difficult with insurance companies as a metric. So I don't know. It looks pretty good to me. It's certainly worth looking more at. I mean, the yield is not anything that is interesting to me. It certainly has a good safety rating. It's got, the rest of its metrics are really good. So that's kind of where I would put it. I would put it in the, I'd want to know more about the company, but I really would want to know why they're not paying, why they're not raising their dividend more, because they can certainly afford to do that. And, but I mean, there may be a reason. They may have some issues from a liquidity perspective, but it doesn't seem like it. I mean, they got an 85 very safe, simply safe dividend rating. So I don't know. That would be one thing that I would want to look at. All right, and now I've got to find out where I left off. So ex-dividend dad says it's best to have a plan for it, though. Yeah, that is. I think he's talking about Michael's comment here about getting paid and investing. So yeah, that's exactly right. So then we got Kevin is dripping dividends is the most passive way of DCAing. Yeah, I think that's right, Kevin. I think dripping dividends is it's pretty passive and it's pretty consistent. And it's kind of a forced DCA, right? Because when the dividend comes in, if it's set up in a DRIP program, which is a dividend reinvestment program, it will automatically get converted into new shares, and so that works as a DCA. So it looks like I'm caught up in the stream. So the question I have for you guys is, the market has kind of taken a dump the last couple of days. So is there anything that you got your eye on? There is one thing I want to go over, but I wanted to ask you what you're looking at. So someone had asked last week about FMC. I don't know who that was. I don't remember. I just wrote down to research FMC. So I did that, and I want to kind of go through that with you, because there's some things that I came across there that I think will be interesting. So first of all, let's kind of refresh our memory on FMC. FMC has a borderline safety score. It's got a dividend yield of about 3.8%. Now, what they do, they're an agricultural sciences company. So they, but they're basically agricultural chemicals. So that's the way to think about it. They try to control insects, weeds, diseases, so they're into insecticides, fungicides, and whatever the other sides are. So they're into those kinds of chemicals. So on October 30th, though, it was downgraded to borderline safe by Simply Safe Dividends. I did not read this note, and so we can go there. I'll just kind of flip through here and see if there's anything of interest. It had a really bad third quarter, and they lowered their guidance. substantially lower sales volumes. It's popping up their earnings payout ratio. You can see that. We'll see that in just a minute. So I'll just kind of flip through this. You can read it at your leisure if you want to catch the live stream when it rebroadcasts. So I'll just kind of flip through this if you are interested in FMC and want to read this right up. All right, so now let's go back to, let's look at let's look at this. You can see there's a huge dividend increase in 2018. They've been pretty consistent since 18. Their last 5 years is 27%. However, they skipped the 2022, December of 2022 payment, or not payment. They skipped the raise. So instead of raising from 58 cents to something else, they decided not to raise. So let's look at their earnings payout ratio. It is shooting up. It was at 29%, which is fantastic in 2022. And now look at 2020. Well, the next 12 months, it is going to shoot up to 60. So it's basically double. And it means that their earnings are coming down. Their free cash flow is really looking horrible. That's, putting it mildly. They're going to be in the next 12 months at a minus 221% in cash flow, their free cash flow payout ratio. And you guys can go check out the video, the live stream that we did where we talked about payout ratios. And we learned that a negative free cash flow payout ratio is not a good thing. Earnings per share, you see it dropping from $7.41. Next 12 months at $3.88, nearly half. And sales growth is going down. Shares outstanding is just a little bit down. Sales are down. Return on invested capital is dropping from 17 to the last 12 months. It was 12%. So they had a really horrible third quarter, it looks like. They've got their debt's rising. And their interest coverage is not looking so good, and that's because their earnings are way off. So let's take a look then at Morningstar, because this is really where I found some gold. And let's pull this up from Morningstar. So this is FMC. We're going to look at this, the full report. So first of all, before I move into that, FMC, they say, is trading at a 44% discount. That's a huge discount. That's almost, it's 44%, but it's almost like half off. It's almost a half off sale. So it says that their fair value is 110, the price is 61. But the devil's in the detail. So this is the actual write-up from Morningstar, and so you read through all of this, and it basically says that they are that they've have part of their chemicals that are coming off of patents. So that means that there's going to be generic, so to speak, chemical producers who can produce these. What do they call them? Diamides or something like that, or diamides, and so they can they're not going to have exclusivity on those anymore. Those are some of their highest margin products. So that's an issue. Their sales are going down because there's what they call farm destocking, where back during COVID and all the shipping issues that we had, farmers stocked up on their chemicals that they needed because they've got to use them to grow their crops. So they stocked up on them. They're more readily available now, so the farmers are actually using up their inventory rather than buying it from FMC. So their sales have taken a hit. So we talked about that and the losing of the patents on chemicals. They've got some near-term profit and margin issues because of that. So there's one other thing I'll talk about in a second. But here's the thing I wanted to show you guys. I mean, there's a big long write-up here, and I'm not going to talk all the way through this, but this right here. In a downside scenario, we assume FMC's new products fail to fully replace the profitability of diamides. As a result, revenue growth slows to a low single digits while margins contract below current levels. In that situation, their fair value is $60 per share. So if you are really positive, optimistic about the future of FMC, then the fair value is around 110. If you're really pessimistic about the future, it's about $60. And so the point of that is that we're at 61.19. It dropped a lot today, like $3 and something. 61.19 is about fair value if you have a pessimistic viewpoint. So I'm not sure that now is the time, for me at least, to invest in FMC. I think we're going to see some challenging quarters coming up. Now, whether all that's priced in or not, I don't know. But there's going to be some challenging quarters. You're going to see FMC struggle at least over the next 2 or 3 quarters. I think, we should keep an eye on it because it is a decent value. And if they are able to kind of get this volume back from the farmers after they kind of liquidate their internal stocks, and then also able to keep some margins for these products that are coming off of patent, I think they could do well. But that's a big unknown. That's a big uncertainty. So the point of this is that that's kind of the way I look at stocks. That's the way I analyze stocks. And if the point I want to draw out of this is, and this applies really for everything, not just FMC, if a stock has gone down in value, there's a reason for it, because the stock market is a lot of different investors, and not everybody gets it wrong. So there are not, if it goes down, there's got to be a reason. It might be a reason that is not worth listening to, but there is a reason. So if you see a stock drop and you go, wow, that's a great deal because it's cheap, you better first find out, and I better first find out why it's cheap, because there is a reason. And this is the reason that FMC is cheap. So if you're okay with that and you believe that they're going to come back to their old days, then it's a great deal. You should be investing now. If you think that there's going to be some challenges and maybe they come back halfway, then, it's a reasonable deal. But if you think of pessimistic, I think it's a little overvalued. So I think, we have to understand why stocks are going down, develop a perspective on that reason, and then decide if we're going to invest or not. And that becomes our thesis. A lot of that also depends on the management company. Management team. And, I looked at their new strategy. They actually call it a new strategy back during their investor day. And there was some stuff in there that I thought was really interesting. So I'm going to withhold judgment on them because I don't know their team very well. I didn't spend hours, looking at it, but they talk about revigorating the relationship with growers. And so my thought is, so you haven't been doing that all along? I mean, that is your customer base. So there's just some things that make me think that they have really gotten out of touch with their customer base. So I'm going to stay away from FMC at this moment. Doesn't mean that, FMC is not a good stock. I've certainly missed a lot of rebounds, but this one to me looks a little shaky. So now it doesn't mean that I won't ever buy it, but I think over the next 2 or 3 quarters, they're going to experience some things that are going to drive them down a little bit further. I could be wrong. So let's, maybe 3 quarters from now, let's come back to this discussion and let's kind of take a look and see what happens. I could be wrong. I got a 50-50 shot here, right? It could either go up or go down. So those are my thoughts on it. So hopefully you found that helpful. So we have Michael here. He says he was a little glib with my friend ex-dividend dad. He always invests across the entire portfolio. Okay, so they're still talking about DCA there. Um, Michael is buying shares in Estee Lauder to get his shares to 100 shares. He's got 15 to go. That's fantastic, man. Estee Lauder looks like a pretty decent stock. All right, we got Greg. Greg says, what are your thoughts on CVX buying Hess? Are you keeping Hess, or thoughts on CVX or XOM? Yeah, so let me talk a little bit about that. So Hess Midstream, which is the stock that I own, is a spinoff of Hess Petroleum. So Hess Petroleum is the company that's being bought by Chevron, CVX. And so Hess Midstream is its own company. It's a spinoff, and it's got its own assets, its own everything, right? The only challenge for me as an investor in Hess Midstream is that there is still a lot of non-public shares that Hess Midstream owns, or not owns, but that Hess owns in Hess Midstream. So it doesn't change anything from an earnings perspective, because all of those shares that Hess owns, it's a little complicated, I'm sorry, but I'm going to try to explain it. So Hess and another company own a lot of shares that are not public, that are shares in Hess Midstream. So you have public shares. I own some of those. Hess owns some non-public shares, and Company B owns non-public shares. So every once in a while, these companies will introduce these shares, sell these shares into the open market. There's been a couple of times this year that Hess Midstream has bought those shares and retired them. So that's just like a share repurchase. But it's not from the public market, it's from private. So the challenge that we have is that Hess owns quite a few non-public shares of Hess Midstream. So if Chevron says, I don't want to do that, let's sell those into the marketplace, we could get a lot of shares dumped into the market, which would then need a place to go, and it might cause the stock to drop. And if it does, I think I'm going to be sitting there waiting to buy some more. So it'll drop for a while, but I think over time it'll fix itself. So that's a great question, Greg. I appreciate you bringing that up, because that is it's a nuance, because even when I talk about it, I call it Hess, but it's really not Hess. It's Hess Midstream, which are some midstream assets that were spun off from Hess Petroleum. Hopefully that helps. Ricardo, looking to catch some AEP or MDT, but they ran up. Dude, I'm having the same problem. So as you guys know, last week I said there were 4 stocks that I wanted to look at. MDT, Medtronic was one of them. RTX was one. Pinnacle West was one. And my brain is not letting me remember the other one. Let me look for it. Hold on a sec. So I've got Hershey. Hershey was the other one. So Hershey, Pinnacle West, Medtronic, and whatever that other one was. So, but all of them are going up. So this market's going down, but my shares are going up. So I don't know, man. I'm just going to hold it. I'm going to hold the cash. I'm going to be patient, because I think that we're going to see a bit of a correction here. That's just my take. I think we're going to see a bit of a correction. So now we got, get back over here. So Miguel's asking about HF Sinclair Corp ticker. I have no idea. I've never heard of that. So let's go take a look. Let's go up here to search. And I think he said it was Dino. HF Sinclair. That's an oil and gas company. I have seen those. That's a little dinosaur. So they're a borderline 60, yield of 3.21%. They had a pretty big dividend increase in February, negative 2%. Look at this, man. 21, they dropped there. Of course, I guess that's a reasonable thing during COVID, but most of the other companies didn't do that. Let's see, what else can we say about them? They're priced about fair if you consider the 5-year average of the dividend yield and the PE ratio. They're right about where they should be. Earnings payout ratio is pretty low. So, but in 20 they had a negative 161%. But their cash flow was fine. So I'm not really sure in 21. I guess they had a minus 14%, but that's not insurmountable. Maybe in 21 there was some real concern about the future of oil and gas. I'm not sure why they cut their dividend, to be honest with you, because dividend is a long-term perspective. Earnings per share looks like it's going down. Free cash flow is going down. They issued some shares back in 22, about 40 million shares. So maybe they bought a company. I'm not really sure. Return on equity, return on invested capital looks pretty decent. Their debt's not bad, and the interest coverage is really good. So, I would say they've got some things that are really good and some things that are not so good. That's what I would say about HF Sinclair. But yeah, I'm used to seeing those little dinosaurs, and so I just wasn't clicking with the name. Oh yeah, no worries. Thank you, my friend, for being here. And Greg, yeah, thanks for the question. I mean, that's a great question, and I really enjoy getting questions where I actually have spent some time looking at the answer rather than kind of off the cuff here. But hey, that's good. So we got Miguel. Miguel is any thoughts on Carrier? Now, Carrier is a manufacturer of HVAC units, I think. Let's look them up. Yeah, building products. So they're at a 61.38% dividend yield. I will tell you this. I have a buddy who owns 2 HVAC companies. And what he's telling me is they are struggling. They are struggling for business. So I think you're going to see the demand for products being down. So it's not a lot people can do about that, or companies can do about that. The demand is down. So I think you're going to see that for Carrier. I think you're going to see it for really all of these HVAC companies. See if there's anything that jumps off the page here. It looks like it's well managed just from looking at the financials. Let's look at return on invested capital is fine. So it looks like a well-managed company, but I think they're going to be struggling because, demand's just low. I mean, there's nothing else that we can really say about that. So then we got Sergio. I'm going to come back on the screen here. Sergio asks if I own any Visa. If not, are you thinking about starting a position? Visa is on my watch list. It's a little bit pricey for me right now, but I do like Visa. I like the business model. I like the fact that it's, they're kind of the middle man. They don't have responsibility for the bad debts and stuff like that. And they can kind of, charge what they need to for each transaction. And it's the credit cards are not going away. Debit cards are not going away. They get a fee on all of that. So I do like their business model. I like their management team. The only thing holding me back from a little bit of Visa is the valuation. And, I was patient with Hershey, and now I've been rewarded by waiting. So I think I'll wait a little bit on Visa. MasterCard is also good. So I kind of see them like Lowe's and Home Depot. They're pretty similar. So I think either of those would be good. Thoughts on Walgreens moving away from boots? I think I'm not really up on this because I don't invest in WBA, Walgreens Boots Alliance. But my recollection is that they tried to sell boots and they wanted more than what they were able to get from it. So, but, maybe there's something that's happened more recently. And if there is, apologize for that. But I think Boots is probably the most profitable piece of Walgreens. So if Walgreens gets rid of that, it's only going to cause, I think, more problems for. The only value to that I see is that it focuses the attention of management. So management can then focus on the Walgreens piece of the business. And I'm not really sure that's a business that I would want to be trying to figure out, because it's difficult. I mean, you got CVS, you got Walgreens. I think Rite Aid now has gone out of business. So it's a struggling industry. They're struggling to have relevance and value in our economy. So, I think that's a challenge. I don't invest in Walgreens Boots Alliance, and probably will not, regardless of the price, however far it comes down. Okay, Michael, Carrier is a spinoff of United Technologies. Yep, that's what I remember that, which ultimately became RTX. Yes, that's right. Otis was also a spinoff. I hear Otis has its ups and downs. Otis Elevator Company has its ups and downs. Great, man. That's a great way to kind of close this broadcast out. I appreciate that, Michael. And the humor does not get past me on that one. That is fantastic. Love it. So, guys, I appreciate you joining, and I really apologize for being late, but there's nothing I could do about it. Could not get my computer to come on. And so eventually it did, and I was able to join. You guys are amazing. Let's go out there, and it's going to be a little tough sledding, right? We're going to have to really stay focused and grab the stocks that we want. Sometimes we have to hold our nose to do that, right? So. As the market's going down, keep an eye on the stocks you like. I've got my 4, but unfortunately, they're not going down at the moment. So, all right, one final thing. My buddy Pat, ARCC, is that Aries? I don't know. Let me look real quick. ARCC, yeah, Aries Capital. I like Aries Capital, Pat. Let me just kind of, I'll just talk about it. So it's a BDC, I think. Let me make sure before I say that. Look at their dividend here. Yeah, it's not qualified. They are a BDC. And I think they are my second favorite BDC. My first favorite is Main Street Capital Corporation. I own shares of Main Street. I do not own shares of Aries Capital. It's not because they're a bad company. It's just because I only have room for one BDC in my portfolio, and Main Street Capital is it. If I had room for 2, it would be Aries Capital would be the second one. So, hopefully that kind of shares my thoughts on it. I think it's well run. I think they're a good company. I just think they're just a little bit behind Main Street Capital Corp. And it's not a huge gap. It's a small gap. But, with only being able to do one, Main Street is my company. So hopefully that helps. El Dynamico. Well, first of all, let's hit Michael. That was fun. Don't forget to hit the like button, folks. Great reminder, Michael. I appreciate you remembering that. And then one last thing here. El Dynamico sold out of Walgreens at a loss, but transferred the rest of the funds into SCHD. I think you're going to be glad you did that, El Dynamico. That sounds like a good move. So, but again, all of this is just my perspective, my opinion. I appreciate you guys being here. I really enjoy this interaction. So come back next time. Next week's topic is going to be diversification. So that should be a lot of fun. We're going to talk about some really, key points about diversifying our portfolios. So with that, I'm going to get off of here. I hope you guys have a great week, and I will see you on the next video, which will come out this weekend, and then the live stream will go back to Mondays starting next week. I didn't want to compete with the football games Monday night. So with that, I'm signing off. I'll see you guys later.